What do you think the Fed should do right now, given where we are in inflation?
Okay, I mean, I've never thought that QE was effective. I mean, QE is it's really not. There's not much evidence that it matters as a policy, and so I would have no problem with ending it. On the other hand, I'm not sure it would make much difference, and I'm not sure exactly. I mean, Larry's right. It is pretty weird to have the Fed doing this, but how important it is to make an issue of that. I mean, the important questions are going to involve interest rate hikes, and I think we're now in a situation where the Fed clearly needs to start hiking rates, and probably not shock therapy, definitely not shock therapy, but the question is whether they want to try and get people's attention. But we are in a situation. This is clearly a very hot economy, and it's the Fed's job to cool it off a bit.
So let's pursue that, because I also did talk to Larry about the rate hikes issue. He did not think there should be a special meeting on rate hikes. He thought March was fine. He wasn't sure about 50 versus 25 basis points. Where are you on how fast they should be raising rates?
I would not be. I'm not sure it makes that much difference whether it's, and so since it doesn't make that much difference, I think trying to not convey a sense of panic says do it by, 25 points a hit. But I think they need to start raising rates and start doing it consistently until there's some pretty clear evidence in the data that the underlying overheating is fading away. It's we are clearly at that point in where the Fed's mandate, appropriate policy is appropriate, calls for rate hikes. It's not a crisis. This is at this point. We can talk about that, but I don't see any sign yet that inflation has gotten entrenched in the economy. So the Fed still has room to engineer a soft landing, but it needs to start doing that.
Well, I'm really interested in that question, particularly the time question. Do we have any sense, do you have any sense, because you're an expert really on inflation, do we have any sense how long we do have? How much of a rush is there? And frankly, do we need to move a bit faster because we took a little bit too long to get started?
Well, I mean, there's a question. I think it actually makes, as long as the Fed is on a consistent policy of fighting inflation, it's probably not going to matter too much. Two reasons why I don't think you need to panic. One is that the question of is there any sign that anything's gotten entrenched yet? And what I look at, we don't have great measures on this, but if we look at either inflation expectations in the bond market or what consumers are telling surveys they expect, everybody expects a lot of inflation. Inflationary expectations for the year ahead have gone way up. But longer-term inflation expectations have risen much less, which says that both investors and consumers, and presumably people actually setting wages and prices, currently believe in what some people are calling elongated transitory. That is, they think inflation will remain elevated for a fairly long time through a lot of this year, but not beyond that, which means that they're not going to be setting prices, doing wage contracts based on the expectation that we're going back to 1979. So that's a reason to say, look, no need for a panic. And always important to remember that the Fed doesn't actually directly control an interest rate that's relevant to business decisions. And investment spending, overall spending, housing, that depends on long-term interest rates, not the short-term interest rate. And long rates are going up. Basically the market is pricing in a lot of Fed rate increases, and whether the Fed actually raises rates, how fast it raises rates is probably a lot less important than having convinced people that it will do, to use a phrase from another central bank, whatever it takes to bring inflation under control.
What is the ultimate end point that the Fed should be looking at? What's the terminal rate, as they say? And should it be a neutral rate or actually a restrictive rate, one that is actually restricting the economy?
If we can avoid getting inflation expectations, baked in, then it doesn't. And then a neutral rate is where you want to go for it, and that's in fact what you want to try and do. The goal here, and when I say soft landing, what I mean is not getting to the point where we actually need to throw the economy into a recession to bring inflation down. And given where we are right now, we don't need to do that. We need to get the economy less overheated, but that probably doesn't mean large job losses. And we need to do that before people start to think, well, maybe the 70s have come back. But we'll probably have a substantial amount of grace period on all of that. Beyond that, I mean, again, we are not. The things I'm looking at now are all about not what is inflation going to be over the next 6 months, because we know it's going to be bad, but is it getting baked in? Is it getting embedded into expectations into the relevant expectations, the expectations? And as long as that isn't happening, then all the Fed really needs to do is effectively remove stimulus. It doesn't need to squeeze the economy.
So, Dr. Krugman, do you have a sense of where that rate is that would be a so-called soft landing? I mean, right now we're seeing inflation, the headline at least, 7.5%. That's a long way away from what you get for a 10-year bond right now. That has to equalize at some point. So where do you think we end up? Is it 2.5? Is it 3? Is it 4?
I mean, the honest answer is nobody knows. I mean, I certainly don't know. And I mean, part of the problem is we haven't had a disinflation episode for a long time. You want to go back, really, not since the early 1990s. And the world has changed a lot. I mean, I had a discourse with Larry in which he was expressing skepticism about how much traction monetary policy even has, which I don't think is right. I think monetary policy still matters a lot for the economy. So we don't know how high the rate needs to go. What is worth saying, though, is that before the pandemic, we were very much in a world of weak investment demand, high savings, low neutral interest rates, a real interest rate that was close to zero on a sustained basis. And there's every reason to believe that we'll be going back to that. So if inflation comes down to, which I think it will, if by some time, probably not till late this year or early next year, inflation gets down to a sustainable level, then you'll be wanting interest rates to be close to the then prevailing inflation rate, which is probably 200 basis points or maybe more than that, but not hard to make a case that it's going to have to be a lot higher than that.
Professor, one last question here. It is a mismatch, as you've explained to others, of supply and demand. Inflation always is. There are some, such as your fellow Nobel laureate, Paul Stiglitz, who is arguing, let's not worry about monetary policy. Let's increase the supply through fiscal stimulus and getting more supply. Larry Summers, on the hand, says that's wishful thinking. Where do you come out?
Oh, I don't think Joe is wrong about that being an important part of the solution down the road, but we do need to think about timing. I mean, any investments in the nation's future, investments in infrastructure and all that will make it easier to reconcile high levels of employment and growth with acceptable inflation, but they take time. And I think we have a grace period before this stuff starts to get embedded, but I don't think that grace period is going to last long enough for new investment in infrastructure, supply-side investments to really have very much of an effect. So I think basically at the larger point about saying, we should be working on the supply side is right, but for 2022, it's all about demand. For 2022, unfortunately, Fed tightening is basically the only game in town.